Welcome back, everybody, to Volatility Trading Strategies. So it's the 1-year anniversary now of one of the craziest events to ever happen in the volatility markets. It's commonly referred to now as either Volmageddon or Volpocalypse, and I've also heard Volnado. That's kind of a good one as well. Typically, it's just Vol with some word for natural disaster filled in. So tsunami would be Volnami. Anyway, the event I'm referring to is that massive volatility spike on February 5th, 2018 that led to the termination of everybody's favorite volatility product, the XIV. Rest in peace, my friend, you will be missed. So today, on the 1-year anniversary, I want to talk briefly about what happened, but more importantly, I want to give you 5 tips on ways that you can potentially insulate yourself against future events like this. So let's get into it. This is a chart showing the largest single-day VIX spikes, going back as far as VIX data goes to 1990. And you can see it there on February 5th, 2018, the VIX index spiked 115%. Now, this wasn't a classic gap-up open where something terrible happened the night before, and by the time the markets opened, everybody was already in panic mode. The VIX actually opened pretty flat that day, and for the first hour or so, everything was fairly orderly. But then throughout the day, it just built up like a crescendo into market close, and we saw that shocking 115% spike. And what's even more crazy is, the S&P 500 only dropped a little over 4% that day. Given a 115% VIX spike, one would have expected a larger crash to be the cause, but that just wasn't the case. As a result, though, the XIV, which at the time was the most popular inverse volatility product, lost 96% of its value and was terminated. Now, the delisting didn't occur for a couple of weeks afterwards, but it was that day that sealed its fate. There was a section in the prospectus for the product that explained what's called an acceleration event. Essentially, if its intraday indicative value dropped more than 80% of the previous day's close, the acceleration would kick in, meaning the product would be shut down. So it was all clearly explained beforehand how it would be dealt with if an event like that did occur, but many traders out there just didn't believe that it could happen. Well, it did. So the next logical question is how? How did the XIV drop 96% when the S&P 500 only dropped 4% that day? Well, I'll try to keep this explanation as simple as I can today, so even people who don't quite understand the VIX futures markets, they can still get something out of the video as well. So simply put, these volatility products don't derive their price based on supply and demand dynamics like stocks do. It didn't crash because a whole bunch of people were selling the XIV that day. Instead, they hold a composition of first and second month VIX futures contracts, and based on the composition of those, the XIV derives its value. But the XIV is not the only one. There's the SVXY, UVXY, VXX, TVIX, ZIV, many volatility products out there, and all of them had to do an end-of-day rebalance of the VIX futures to maintain their target exposure. And because the S&P 500 was also down, there's hedging behavior, and that often finds itself in the options and futures market. So essentially what we saw in a nutshell was a big convoluted liquidity event. In the years leading up to February 5th, the volume in the ETP market was growing substantially, and actually became fairly large in relation to the VIX futures market. You probably saw a lot of articles in 2017 talking about the overcrowded short vol trade. So what happens when you get that much volume being pushed through a market that was already stressed? You get Volpocalypse. The XIV itself was only down about 30% or so during regular market hours, but after that rebalancing after the close, it was basically toast. So that's actually the first tip I will mention today to potentially avoid future issues. The volatility products are intertwined with VIX futures. So the short volatility trade does become increasingly more risky with increasing assets under management for the ETPs. So it's a good idea to keep an eye on the overall size of these markets. At the time of making this video now, it's no longer the risk it was then, but it's a good idea to keep an eye on things. I will, of course, mention it anytime the risk becomes elevated as well, so you can check back with my content, or just track it yourself. The second tip I have, and this goes beyond just trading volatility products, this applies to any type of trading, but always expect and account for worst case scenarios. You don't want to be that trader who's always saying, oh, that can't happen. Volatility products can't terminate. The S&P 500 can't drop more than 7% in a single day. Bitcoin's fine, buy and hold it. It always comes back. You don't want to be that trader because one day you might get blindsided. Now, all the signals that I track had me in cash well ahead of that volatility spike. But one of the reasons for that is I did anticipate termination as a possible outcome, and I traded accordingly. That can't happen if you're not willing to acknowledge the risk. So yeah, number 2, always expect the unexpected. And I was also giving warnings in my articles and videos for years, trying to get the message out to people that termination is a possibility and they need to adjust their trading accordingly. I have a 5-part series on YouTube called the Risk-Adjusted Return Series. And in all of those videos, I talk about how inverse volatility products like the XIV had terrible risk-adjusted metrics, and large price fluctuations are to be expected. I'll leave a link here to part 1 of the series, and if you have time, go through them. I get a lot of good feedback from that series. Risk-adjusted performance metrics are, in my opinion, the most important thing for investors to understand if they want to be successful. I was also repeatedly reminding traders on message boards and comment sections about the risks involved so they can adjust their overly aggressive nature before it's too late. I'll just flash some of those comments on the screen quickly here so I don't take up too much time in the video. But they may be worth a quick read, so come back later and pause the screen if you want to see some of them, and feel free to ask me any follow-up questions. I'll also play a short segment here from an old video I made called the Volatility Landscape. The conclusion I reach applies to all trading, so it is a good reminder. Now the question becomes, how much of a concern is this really? Is it possible for these products to lose 80 to 100% in a single day? The short answer is yes. Now in a practical sense, the odds are pretty low, but it does need to be said that this is technically a possibility. And if you view it through the lens of quantum mechanics and Murphy's Law, one might be inclined to say that on a long enough time horizon, it's not only possible but likely. The Black Monday crash of 1987 would easily have done it. So whether an event like that can happen again in the future is up for debate. But the way I look at it is, acknowledging that volatility products can go to zero in a single day is valuable. It makes the trader put risk management at the forefront of their strategy building. It means that no matter how badly we want to get aggressive and shoot for huge profits, as responsible traders, we just can't. Nobody knows if and when this type of event will occur, so really the only line of defense is making sure that we're only allocated to trades during the most ideal times and making sure we're in cash for all of the rest. So whether people thought it could or it couldn't happen, at this point it doesn't matter. It did happen. So let's move on to a few more tips on how people can mitigate future risk. Because that's what's most important, isn't it? I've personally been trading volatility for 15 years, but I also know that I've got at least another 30 to go. I can't get caught sleeping, not even once. So here's a few more tips on how people can reduce future risk. The third tip is to maintain conservative portfolio allocations. This should be the first line of defense for literally every higher risk trading strategy you ever employ. I don't care how good you think it is, how much money it's made in the past few years, always allocate conservatively. For me, I have had success with volatility products since they launched, but yet still, I only allocate 20% of my portfolio to these types of strategies. I'm very careful trading them, but even if I do take an unexpected hit someday, it's not going to derail the entire portfolio because I've allocated correctly. So that applies, of course, to all trading. Allocate small. Tip number 4, conservative investing style. What I mean here is, within the actual strategy, it's also a good idea to trade conservatively. No buy and hold, no using leverage, no chasing big gains. All 3 of my strategies have plenty of cash allocations during times of elevated risk. Anywhere from 63% of trading days in cash to 28% days in cash, depending on the risk tolerance. This also dramatically increases the odds of avoiding bad days. If a trader is willing to hold cash anytime the signals aren't a full green light, there's a great chance those bad days are avoided because they don't typically sneak up out of nowhere. There's warning signs in advance. And being conservative and moving out of trades when you see them develop is a great policy to ensure long-term success. And lastly, tip number 5, constant portfolio rebalancing. What this means is constantly rebalancing your portfolio to always reflect the desired lower portfolio allocation. My volatility strategies with that 20% allocation have returned substantially more than my core portfolio holding that has a 50% allocation, which means if I just let them go unchecked, it wouldn't take long before the volatility strategies overtook the core strategy and had more money trading within it. So it's very important for me to be constantly rebalancing my portfolio to ensure that my vol strategies are only 20%. The simplest way to do this is, with every fresh new position, always take it with the desired allocation. So if that's 20%, the next new trade I take, I only allocate 20%. If it's 10%, then the next fresh trade gets a 10% allocation, always maintaining that desired allocation with fresh new trades. Now, I hope it's obvious that buy and hold is a terrible idea, and I don't recommend it under any circumstances, but just to use it as an example, using the long-term chart of XIV here, if a buy and hold investor just put $10,000 towards it in 2010 and let the money sit there to grow in the account, at a few points along this curve, they would have been very happy, right? They would have seen their capital grow quite a bit. Maybe they would have thought they were going to be rich off it, go out and buy a fancy car or a bigger house. But after the termination event, their money would now only be about $6,000. 8 years later, from $10,000 to nearly $150,000, then back down to $6,000. However, if that investor was constantly rebalancing the portfolio along the way, making sure its overall allocation always matched the desired amount, they would have effectively been taking profits out the entire time. Which means even after the termination event, their $10,000 would have made them a lot of realized profit over the 8 years. So it was an interesting ride for the XIV over its 8-year lifespan. There were plenty of opportunities to make money with it, and there were also quite a few scary drawdowns along the way. In the end, it did finish negative. The annualized return was minus 6.25%, with a Sharpe ratio of minus 0.12. So as poor as some hedge fund managers have been at trading volatility, as proven by the SIBO Eureka Hedge Short Volatility Index, the XIV over its lifetime was even worse. And if you watch my risk-adjusted return series I linked to earlier, in there I actually discuss XIV and why this happens on poor risk-adjusted performers. If you are somebody who lost money trading this product in the past, if February 5th did catch you by surprise, I am sorry for your losses. I heard some horror stories, and some of them nearly brought me to tears. But there's definitely some lessons here for all of us, and we can use them to insulate ourselves against future events. Number one, keep an eye on the overall size of the volatility ETP market, and compare that to the size of the VIX futures market. If they are in balance, then those rebalancing shouldn't be an issue. But if they're not, you may want to consider scaling back your trade allocations. Second, and this goes for all trading, always acknowledge the risks and give serious thought to worst-case scenarios. It doesn't mean you have to run scared from them, but it does increase the odds that you've properly accounted for potential black swan events. 3, conservative portfolio allocations really can save you, even if you do get caught in a bad trade. Never over-allocate. 4, conservative trading within the strategies. I personally make safety positions and cash a major part of all my investing, and I'm not afraid to hold cash for extended periods of time if necessary. I don't ever say, okay, well maybe this time it'll be okay. No, I can't get caught sleeping, not even once. If the metrics that I track don't support a trade, I just don't take it. And sure, there are times when you watch the market go up and you think, yeah, it would have been nice to be in this one. But I have to stay true to the big picture. 30 years, not 1 month or 1 week. And lastly, constant portfolio rebalancing. Try to keep that allocation at the desired level so you are essentially realizing the gains over time. We will miss the XIV. Now, I do think that eventually future products might be released, and maybe a few others will fail in the future. But with these 5 tips, we really can tame the volatility markets. So thanks for watching. Please check out my website, sign up for the free 2-week trial to see what the VTS community is all about, and above all, be safe. This is 10 years into a bull market, so be prepared for anything. Take care. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.